What if I told you there's a powerful yet simple way to build a secure financial future, especially if you're a federal employee or a member of the Uniformed Services? No, it's not some complicated investment scheme. It's your ticket to a comfortable retirement, and it's called a Thrift Savings Plan, or TSP. In this video, I'll break down the absolute basics of the TSP, what it is, why it's a game changer for your retirement, and most importantly, how you can invest your money to help it grow. I'll even get into some sample investment strategies for every stage of your career. So whether you're a brand new hire or you've been contributing for years and want to make sure you're on the right track, this video is for you. Think of the TSP as a retirement savings and investment plan similar to a 401k in the private sector. It's a way to put aside money for your future directly from your paycheck. But here's the magic part: the government helps you out. For most federal employees under FERS system or members of the Uniformed Services under the blended retirement system, you get an automatic 1% contribution to your TSP from the agency or service, even if you don't put in a single penny yourself. That's free money. But it gets even better. When you start contributing, your employer will match your contributions up to a certain percentage. They'll match dollar for dollar for the first 3% of your basic pay that you contribute, and then 50 cents on the dollar for the next 2%. To get the full match, you'll need to contribute at least 5% of your pay. Seriously, if you do nothing else, contribute at least 5% to your TSP. Not doing so is like turning down a raise. With a traditional TSP, your contributions are made before taxes are taken out. This lowers your taxable income for the year, which is great for now. You'll pay taxes on the contributions and their earnings when you withdraw the money in retirement. With a Roth TSP, you contribute money that's already been taxed. The big advantage here is that your qualified withdrawals in retirement, including all the earnings, are completely tax-free. The right choice for you depends on your personal financial situation and what you think your tax rate will be in retirement. Many financial advisors suggest a mix of both. Now, let's compare the funds. First up, we have the G Fund, Government Security Investment Fund. This is the safest of the bunch. It's invested in short-term U.S. Treasuries that are specifically issued to the TSP. Your principal is protected by the U.S. government, so you won't lose money in the G Fund. The trade-off is that its growth potential is the lowest. As you can see on the chart, it's probably not even keeping up with inflation, and it looks like it's about 2.5% over the last 10 years. Next is the F Fund, or the Fixed Income Index Investment Fund. This fund is a step up in risk and potential return from the G Fund. It's a bond fund that tracks the Bloomberg U.S. Aggregate Bond Index. It's considered a conservative investment, but can experience some fluctuations. You can see at the 5-year it was a negative amount, and since it started, it is about 5.25. The C Fund, or the Common Stock Index Investment Fund, tracks the S&P 500 index, which is made up of the 500 largest U.S. companies. Think big names like Apple, Amazon, and Microsoft. The S Fund, or the Small Cap Stock Index Investment Fund, invests in small and medium-sized U.S. companies that are not in the S&P 500. These companies have a lot of room to grow, but they can also be more volatile. And finally, the I Fund, or the International Stock Index Investment Fund. This fund invests in the stocks of companies in developed countries outside the United States. It is a great way to diversify your portfolio internationally. So how do you choose which funds to invest in? This is where your personal situation, your age, how comfortable you are with risk, and when you plan to retire comes into play. For the ultimate set it and forget it approach, there are the L funds, or life cycle funds. The L funds are a mix of the 5 core funds, G, F, C, S, and I. You simply choose the life fund or the L fund with the target date closest to when you plan to start withdrawing your money. For example, if you plan to retire around 2050, you should choose the L 2050 fund. The L fund automatically becomes more conservative as you get closer to your retirement date, shifting from a higher percentage of stocks to more bonds and government securities. This helps to protect your earnings as you near retirement. For most people, the L funds are an excellent and simple choice. You might need to pause the video to take a longer look at this chart. The funds that are farther out in years are more aggressive. As you can see, they get more and more conservative as they get closer to today. There are also some gaps in the chart. Those funds didn't start until 2020 and therefore don't have enough time to have data in those categories of 5 years or more. For the young and aggressive investors who are 20 and 30 years old, the goal should be to maximize growth over a long time horizon. The sample allocation would be 80% stocks, which would be 40% in the C fund, 25% in the S fund, and 15% in the I fund. And then 20% in the bonds or government securities. You could do 10 in each F fund and G fund. The rationale, with decades until retirement, you have the time to ride out the ups and downs of the stock market and take advantage of the higher potential returns. The well-known financial advisor Dave Ramsey recommends putting 60% in the C fund and 20% in the S and the I fund. His rationale is you should be more aggressive. For the mid-career or moderate investor in their 40s, the goal is still focused on growth, but with a bit more eye on capital preservation. Your allocations should be 60% stock and 40% bond. The rationale is you're still looking for solid growth, but want to start dialing back the risk slightly as retirement gets closer and closer. For the pre-retirement or conservative investor, say in their 50s and beyond, the goal is to protect the wealth you've built while still aiming for some moderate growth to outpace inflation. So a 60% bonds and 40% stock allocation might be good. The rationale, with retirement on the horizon, the focus shifts to preserving your capital and generating a steady stream of income. Phew, that was a lot. But hopefully you now have a much clearer picture of the Thrift Savings Plan and how you can make it work for you. Here are the key takeaways. Contribute at least 5% to get the full government match. It's free money. Understand the difference between traditional and Roth TSP and choose what's best for you. The L funds are a fantastic, simple option for most people. If you choose your own funds, rebalance your portfolio periodically, about once a year, to maintain your desired asset allocation. The most important thing is to start saving and investing as early as possible. The power of compounding is incredible. For more details, be sure to visit the official TSP website or tsp.gov. They have a wealth of resources, including fund performance data and planning calculators. If you found this video helpful, be sure to hit the like button, subscribe for more content on personal finance, and share this video with fellow federal employees or service members who could benefit from it. Thanks for watching, and here's to a wealthy and well-deserved retirement.